Every major financial crisis has a moment that on the surface looks small, but underneath signals that something is very, very wrong. Last week, we hit that moment, and if you understand what just happened, you'll understand what's coming next. Last week, Renovo Home Partners, a home improvement company backed by BlackRock, abruptly went bankrupt, leaving them $150 million in the hole. But just a week prior, BlackRock had deemed its private credit extended to Renovo to be worth 100 cents on the dollar, leaving many to wonder, how do you go from full value to worth zero in just a matter of days? But the answer is it's easy if the value was never real to begin with. If it was nothing more than an illusion of stability, an illusion that is quickly breaking down as revealed by a recent string of abrupt failures. Failures that pose real risks, not just to investors, but to you, me, and the entire financial system. Renovo isn't the first private credit-fueled company to collapse after being highly valued mere days before. In fact, it's simply the latest. Tricolor, First Brands, and others all follow the same pattern. Highly valued, sudden collapse, major losses, which have investors, regulators, and banks deeply worried. Because while private credit itself isn't inherently evil, it is extremely opaque, meaning that there's little oversight, minimal regulation, and almost no reporting. So no one actually knows what anything is worth. But how big is the risk really? Shadow banking, or non-traditional bank lenders like money market funds, hedge funds, and private credit now account for nearly 15% of total assets. In fact, the shadow lending sector as a whole worldwide accounts for nearly half of all financial assets. We are talking hundreds of trillions of dollars. But the risk isn't just the size. It's the fact that shadow banking has now woven itself into every corner of the financial system, meaning that when these collapses happen, they don't stay isolated.